Steph, we touched on industrials already, and I get your point that you want to be in the names that have pricing power, but the broader cyclical sectors were meant to be the areas to benefit in the current environment. Do you worry with a day like today when all of those sectors are sharply lower that that's already a kind of consensus trade?
I don't think it's consensus. I think people are talking about it. I don't know if they're actually acting on it, Wilf. But look, I think at the end of the day, you have to be confident that the economy is going to be above trend and stay above trend, and that inflation is going to be greater. Hopefully, it's not going to be runaway inflation. But even commodity prices, by the way, Wilf, have recovered quite nicely. Look at oil's up 90% year over year. But copper and lumber are also back up to new highs in terms of recent highs, not back to the old highs, but they're still up. And we have wages and shelter costs inflation, which are much more sticky. So you do have better growth. You have more inflation. I listened to a company called Paychex. They're a payroll HR company, and they reported earnings today. They blew it away. They saw double-digit revenues and earnings, and the CEO said it's because you're seeing a stronger economy and a resilient small and medium business environment, which I thought was really very interesting. So we're hearing from companies that things are actually good. They're pretty good. And so that's why I want to be involved. And that's on top of what Expedia said last week and what Wynn said last week, and Kayak saying that searches are actually on the rise, reservations are on the rise. So that's why I want to be involved. And these stocks are down a lot, as we talked about earlier. And so I want to be buying these stocks because I see value in them.
Steve, what about you? Has your sentiment changed? The market always likes to climb a wall of worry. There are always headwinds out there, and Washington is a familiar one. The Fed and tapering is a familiar one. Is this time different?
Sarah, to some extent it is. I know it's incredibly dangerous to say this time it's different. But I think what we're seeing now is we've had more or less the perfect storm for the last 18 months. It's been great. The Fed, has been pumping in liquidity. The fiscal policy has been a real tailwind to the markets. The economy, as Stephanie was just saying, has been wonderful for a whole bunch of companies. I don't think that at the corporate level that we're going to see the problems, but where I do think that we have to think differently is we really don't have the same monetary tailwinds that we've been having. The Fed is telling you they're taking their foot off the accelerator, and they're telling you when they may tap on the brakes. And the fiscal stuff obviously didn't matter too much today because the market plunged when the news came out that they were not going to shut down. So I think that was kind of irrelevant, as Mike alluded to. But the fiscal side is not as friendly as it's been either. So I think you have to look at stocks with a different lens than you have over the past 18 months or so.